All right, well, you know what? We've got David Semmens from Standard Chartered Bank. So let's find out more from him and find out what the better-than-expected rise in existing home sales means for the market, and whether there was somehow a link between that housing report and what we saw in the Treasury auction. David Semmens is a Bloomberg best economist, as I said, from Standard Chartered Bank. David, you know, you're an economist and you're a Bloomberg best. Can you explain why anyone would actually buy a Treasury security, but really, in a sense, not get anything back from the government, get a negative yield?
Well, I think it's just that people are concerned about inflation a little bit out, but in the near term, they're really not concerned about inflation. And it's a good vote of confidence to the Fed that people still feel that QE2 is going to work, and that the Fed's saying they're...
QE2, not the ship. This is the Federal Reserve program to buy assets in the marketplace.
So the second round, the one that everyone is expecting on the 3rd of November.
What are they going to buy, do you think?
I think they're going to be buying treasuries. They're going to be buying treasuries because the market simply isn't deep enough in mortgage-backed securities, and also it's the most liquid instrument in the world. If you want to pick something that you know you're going to be able to be fluid in, that's what you're going to use.
But is it possible that the Federal Reserve doesn't have enough firepower to actually influence the direction of Treasury yields?
I think that would really be a terrible shame, because if the Treasury can't do it and the Federal Reserve can't do it, really, we should abandon all hope. I think the Fed is going to come in. They're going to come in very large. They're going to surprise the market, I feel. If anything, they're going to be doing more and then take it back later. They're going to say, they're going to commit to doing more with the proviso that how the economy performs will be a guarantee upon their next move.
How much is more these days? Are we talking $500 billion, $1 trillion, more than $1 trillion?
$1 trillion plus, really.
$1 trillion plus?
I know we throw around these numbers that they don't mean anything anymore, but yes, $1 trillion plus. I mean, the range of expectations are from $500 billion on the low end to $1.5 trillion. But I think what will be really important for the market to see is for them to have a pretty much open-ended intention just to keep going until the economy turns around. And that is what would really get the market excited, and that would really be very positive for bonds.
How would it be positive for the market if this $1 trillion plus amount that you're describing is basically being created by the Federal Reserve? Because do they have $1 trillion plus? I mean, where do they get the money to do this?
Well, they get it from the Treasury. But the thing is, it's going to be making risky assets even more attractive than they are if they do more than people expect. At the moment, people have got an expectation of around $1 trillion. And if they do more, it's going to make risky assets even more attractive than it will do after they've conducted this movement.
Well, you know, I tried to figure out exactly what was $1 trillion, you know, and I looked up online this whole idea that you could actually get a stack of $100 bills and you'd get, you know, 10,000, then you'd get $1 million. And apparently $1 trillion is if you stack $1,000 bills, you go up to the Empire State Building, that's about $1 billion. You need 1,000 Empire State Buildings for $1 trillion. This is a lot of money we're talking about.
Yeah, I mean, it's hard to conceptualize, but it's really just, in a way, numbers on the balance sheet of the Fed, because, you know, they're adding to their assets and their liabilities with this move. But I mean, the thing is that they want to be preemptive. They want to be acting quicker, and they don't want to be like it was in Japan, where they waited to see how things were. They would rather do too much and have too much growth and too much inflation than have not enough growth and not enough inflation.
David, take into account today's U.S. existing home sales numbers. The increase, what were we, 4.5 million? I think the estimates were for about 4.3 million. So this was a positive surprise.
Yeah, I mean, it's a better than expected number in terms of the sales. The thing is, we're still...
I knew you were going to give me a but. There's a but in here, isn't there? Right.
We're still going to look for falling house prices. The thing is, sales should pick up while prices edge down. And once we move back into equilibrium, then they can both start moving up again, which is what everyone really wants to see. Everyone would like to see housing sales increasing and prices going up. But at the moment, while you see house sales edge up, you are going to see prices come down just to make them more attractive. You still do have far too much inventory in terms of the months available for sale. And also, people aren't borrowing because they're still concerned about the outlook. But yes, on balance, it's a positive number for once.
And you're so, well, that coming from you, I mean, I'm shocked that's such a positive statement.
I know, don't tell anyone, please.
So, all right, so we get the combination of perhaps prices stabilizing in the housing market. We get the Federal Reserve coming in with their program, perhaps after the midterm elections, announcing exactly what they're going to buy and in what quantity. What does that tell you about, let's say, the fourth quarter and going into 2011 for the U.S. economy? Does it sound as if things could actually start to turn around and be quite positive?
I mean, I still think there's going to be some drag on the housing market going through well until probably the third quarter of next year, just from prices simply taking a longer time to adjust. And they are being supported because the government is slowing down the foreclosure legal route. And so the problem is that slows down the adjustment. But the thing is, once that has worked through, then housing will become an attractive option again. People will start moving, and hopefully you will see some construction adding to GDP going forward. Now, I wouldn't get carried away and say it's going to be especially positive. We are expecting the fourth quarter of this year and the first quarter of next year to be quite weak. But the thing is, we're not looking for there to be a double dip. We are looking for it to carry on growing, which is definitely much better than we were seeing in Japan when they were talking about these sorts of measures.
All right, so if the economy is going to carry on growing, what would that mean for the U.S. dollar? We were talking during the break about currency pairs, the dollar versus the euro, the dollar versus the yen at a 15-year low right now. The yen so incredibly strong. What does that tell you about currency values?
I still think the Fed is going to be remaining on hold for quite some time, and you are still going to be seeing dollar weakness, but there's no real concern the dollar is going to be losing its status as a reserve currency of the world. If it wasn't the reserve currency of the world, it's hard to see what deliverable options you would have. When people were talking about the euro being the world reserve currency, we then ran into all the problems that we had with the euro credit crisis, and it just showed that it's not really a match for the USA at all, or the US dollar.
Where do you find the possibility of an outlier event? Because it seems as though just when everything goes in one direction, something that we did not predict, something that we weren't even considering, comes to the fore and rattles everybody's attention once again.
Well, in the previous two big double dips that we had, they were caused by monetary policy being tightened too early. I feel that the Fed is being fully briefed on this. They talk about it frequently in their speeches or just mention it. I don't think there's any danger of the Fed raising rates too early. If anything, they will probably raise rates too late, as I said earlier, and let growth and inflation pick up a little bit. I guess the upside risk from the typical view that I would put out is that perhaps things do come back very hard and very strong in the nearer term than people are looking for. And that would catch people off guard because there is much less of a voice in the market at the moment that thinks the US is going to be coming back and printing, say, 5% growth in the next 2 or 3 years. It's very hard to come across someone who thinks that. And so that would be an outlier, and that would be someone who can make a constructive case for that would obviously catch the market's attention. But unfortunately, with the consumer continuing to deleverage, it's very hard to see that.
What about the acceleration of inflation? We spend much of the day looking at commodity prices, whether it be cotton. In fact, cotton trading was halted because it reached its limits for the day in terms of trading. We've seen corn prices, oil over $82 a barrel. Are you worried about an acceleration in inflation?
At the moment, you've still got capacity utilization still very, very low. It's still far too low to cause any inflationary concerns. And again, the same in the labour market. So from that perspective, there's no real inflationary pressures there. You are seeing a creeping up of producer prices, and that is causing inflationary pressure on the input side. But the thing is, there's no real capacity on the consumer side to absorb those price increases. So you're seeing people's margins being squeezed rather than the consumer being squeezed further.
But if that's the case, if margins are being squeezed, then why do we see stock prices move up? They're not going to be able to pass on those increased raw material price costs.
Because people are simply looking at interest rates to stay lower for longer, and it makes stocks more attractive.
Do you think that the bond market, the rally, is nearing its end?
I still think that the Fed is going to be coming in and using shock and awe and doing more than people will be looking for.
More than $1 trillion?
More than $1 trillion. If I had to go for above or below, I would go for above. I still have a lot of faith that the Fed is going to do everything it takes. These people really just want America to succeed. That is essentially their mandate.
Well, they've got the dual mandate, right? They've got the stability in the economy, plus they've got full employment. I want to thank you very much, David Semmens, a Bloomberg Best economist, joining us from Standard Chartered Bank. As always, a pleasure.